Boy, the going sure is getting tougher for dividend investors, particularly in high yield stocks. We've seen a number of high yield stocks tied to renewable energy and utilities absolutely get smashed over the past week. Names like Next Year Energy Partners, similar companies like Brookfield Renewable, all down by double digits or more. Investors need to be asking themselves, is this the beginning of a reckoning that's going to carry over to other dividend stocks too? What about the non utilities? What about those blue chip dividend darlings, those stalwart, those companies that we think we can just own it and they're safe and they're not going to lose us any money? Well, let me tell you, you may need to be thinking about a reckoning that could be coming for a lot more dividend stocks than anybody wants to acknowledge. I'm Jason Hall. This is The Smattering. We're going to talk about what's going on right now, what investors need to be thinking about doing, and why it matters. Before we do that, though, just a reminder, our videos are sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. It's fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, what in the world has happened? And as you can see in purple, Next Year Energy Partners has drug this entire group of businesses down. I'm recording this on October 3rd. So this is really stuff that's happened in the past week. Next Year Energy Partners down 54%. Its parent company, Next Year Energy, down 24%. Atlantica Sustainable down almost 26%. Really similar to Next Year Energy Partners. Then we have two similar companies that there are some differences. Brookfield Renewable, Clearway Energy, both down more than 22%, basically in a week. All right. So what's happening with these companies in particular? The short version is it's interest rates. Okay. These companies use a ton of debt. They use a lot of debt to acquire power producing assets, also power transmission assets, mostly renewable energy assets, things like wind farms, solar farms, the power transmission that connects them to the grid. This is not a collapse. I want to be clear here. This is not a collapse in renewable energy. This is a revaluing of the market of the businesses that own these long-lived production assets. You can look across the entire utility space. In this same period of time, a lot of utility stocks are down 5-10% in only a few days' time. That's typically one of the lowest beta, meaning lowest volatility, segments of the market to invest in. It's usually really, really stable. Investors are starting to realize rising interest rates aren't just a short-term temporary phenomena, and that rates could stay higher for longer than most people have been willing to accept or even realize could happen up until now. So again, the core businesses, the story is they use debt largely or stock to buy assets. You look at Next Year Energy Partners and Atlantica Sustainable. What is their core business? They have parent company sponsors that are utilities. Those companies use those two businesses, particularly Next Year Energy Partners, as a finance mechanism. If I'm Next Year Energy, over the past decade, I've gone out and I've acquired and I've built a lot of wind farms, some other renewable energy assets, even some gas pipelines, and I've had them on my balance sheet at the parent company level, and then I've dropped them down. I've sold them to Next Year Energy Partners. Next Year Energy Partners has acquired them in one of two ways. They've either taken on debt to do it or they've issued stock. In the past, the stock price was much higher. The effective cost of capital to do that when you did a used stock was whatever the dividend yield was, right? You got that dividend you pay. If you took on, you used debt to do it, it was your interest payment, right? That was your cost of capital to do it. Both of those things have gone up a ton as the stock prices come down and they've committed to keep the dividend payment where it is. The yield's gone up. All of a sudden, you can't issue stock anymore on these deals and make any money. The returns are not going to be there. If you're going to get a 5 to 10% return, cash return, and you're issuing stock at a 12% dividend yield, and even if you're getting a 10% cash return, it's 12% cost of capital. Guess what? You're losing money on the deal. You're not going to do it. Next Year Energy Partners just said, so we're going to just focus on organic growth. So we're not going to do drop downs right now. So they're not going to, all of a sudden, there goes Next Year Energy's primary growth tool for its renewable energy pipeline of growth. It's going to be a lot harder for them to grow that business that way. The market sees what's happening, extrapolates that, sends all utility stocks down as a result, and also sends the stocks down of similar companies to Next Year Energy Partners. Again, Atlantica Sustainable, its parent company is a utility. Same thing. that drop down, that top of the funnel, it's the same effect. Now, it's a little bit different for Clearway Energy and Brookfield Renewable. Their parent companies are infrastructure and alternative asset investors. They're not dropping assets down. They're not using it as a financing mechanism. It's more of a co-investment and asset management mechanism. In other words, investors in Brookfield Asset Management, one of their funds, they may need some additional capital to get a deal, or maybe Brookfield Renewable needs some additional capital to get a deal done. So they'll co-invest in these assets. And then you've got Brookfield Renewable that can run it as well. It can be the operator. Similar with Clearway Energy with its privately owned asset manager parent company. So anyway, the story's the same. Cost of capital is up. Their stock prices are down. They got sent down even more as the market realized what's going on. For this particular cohort of companies, investors need to reset their expectations about dividend growth. Brookfield or Next Year Energy Partners, they put it in writing and they said it. They basically cut their dividend growth profile in half. They had been saying we can grow like 11, 12, 13% kind of area, low double digits. They cut that down to like 5%. They've really, really reduced it substantially. But that puts it more in line with Brookfield Renewable and Clearway Energy with their expectations to be able to grow their payout. Investors just need to realize that higher cost of capital means you can't grow things like your dividend as quickly because there's a give and take. That is a reality. Now, let's take this a step further. Here's some other stocks that have fallen substantially over this same period of time. It's not just these utility companies. This goes back to this summer. So, July, August, really when this sell-off kind of happened. Now, Target is the outlier here. Target's had other issues that it's been dealing with, going from inventory issues a year ago, some concerns about its social stance and affecting potential customers. That's kind of affected its business results a little bit and also outlook for the stock. And of course, the business results as well. Again, you see the same thing. We've got Kroger. It's kind of a slow growth, dividend growth investment. Coke and Pepsi. These are strong brands, a lot more asset light than you might think because they use a lot of bottlers to do a lot of the bottling. They own the brands, they own the IP, right? So the point is double-digit declines, right? These are steady, reliable, stalwart businesses. Why am I bringing those up and what is the point? I think the point is that a lot of investors have been looking at these steady eddy, reliable blue chip companies as a place of safety, particularly starting at the beginning of this year, and as a good place to say, hey, I can go buy some Coke, I can buy some Pepsi, I can own Kroger, and you know what? I might not make money, but I'm not going to lose money. And they got that little dividend there that's, it's not a great yield, but it's safe and it's dependable. What we're starting to see happen, I think investors need to accept the fact that this is a reality that's part of a change in the cost of capital environment. Investors have been looking at yields last year, 2 years, even 5 years ago, and extrapolating those yields to prices they were able to pay more recently and saying, you know what? This is cheap. You know what? This is safe. And the reality is that we haven't seen these sorts of interest rates in 15 years, 20 years. Here's the reality. There's a lot of investors that bought one of those blue chip stocks or multiple of those blue chip stocks earlier this year that said, you know what? I need to preserve my capital. Why am I risking money in a stock when I can get 5% in a 10-year treasury a year? And at the end of 10 years, I'm going to get all my money back. I can get 5% in a T-bill right now, in a 30-day treasury in some cases. I can get 4.5% in a savings account. Why am I risking my money in a low yield blue chip stock when the economy is still a concern and it looks like interest rates are going to stay higher for longer? Investors are considering their options outside of stocks for safety and for yield. This is the first time in a lot of people's investing career that was another choice, that there was something that you could do for safety and yield and income besides buying dividend stocks. So I think investors need to be conscious of the fact that we really could see a protracted period of revaluing of a lot of even these blue chip safe stocks. And we could see what's happening with these utility businesses, these renewable energy yield cos, is just kind of the beginning of a significant revaluing of a lot of these stable, no growth, slow growth companies, simply because there's competition for investor capital that's truly safe in things like treasuries and investment grade bond that can provide enough income and an adequate rate of return to meet the goals of the investors who want income while also meeting the goal of capital preservation that investors just haven't had to think about for more than a decade. So my best idea, and this is something that I'm doing with my own money, is if you're thinking about security and you're thinking about safety, you may need to look beyond stocks. If you're looking to grow your wealth over the long term, 5, 10, 20 years, that's where stocks come into play. That's where dividend stocks, dividend growth stocks can be a big part of your portfolio. I want to encourage people, again, check out our special link, fool.com/the smattering. The Motley Fool's got 10 of its best stocks to buy right now for you. Check off that link for even more great ideas. If you're looking for safety, think about cash, think about bonds, and that's going to be the smart way to play.